Pause whatever you're doing for a moment and give me your full attention. Because what I'm about to walk you through isn't background noise, it isn't market gossip, and it definitely isn't clickbait. This is one of those rare moments where the plumbing of the financial system starts making sounds it's not supposed to make, the kind of sounds that only happen right before something expensive breaks. It's Monday morning, January 5th, 2026. Wall Street is coming back to life after nearly 10 days of holiday silence. The elevators are full again. The espresso machines are screaming. Traders are back at their desks, half awake, half annoyed, expecting the usual January ritual. Light volume, slow starts, nothing dramatic until later in the month. That expectation lasts about 5 seconds. Because when the terminals light up, what's staring back at them isn't routine, it's not even volatility, it's structural damage. The global silver market isn't wobbling, it's not correcting. It's coming apart at the seams in real time, and the worst part is that this didn't begin today. It began quietly, while most of the senior decision makers were somewhere sunny, snowy, or irresponsibly expensive. The chain reaction that started during the holidays is now accelerating, and it's threatening to reshape the precious metals landscape for years, possibly longer. Everything I'm about to describe isn't theory or speculation. It's built from hard data pulled from CME position reports, CFTC filings, vault inventories, and shipping records. These are the boring, unsexy documents that no retail investor ever reads and no mainstream analyst ever leads with. But when you line them up side by side, they tell a story so uncomfortable that I genuinely hesitated before putting it out. Not because it's complicated, but because once you see it, you can't unsee it. What's happening right now has a name. I call it the Monday Morning Massacre. And buried inside it is what I can only describe as a 215 million ounce financial landmine, a position so badly constructed that it has the potential to cripple major financial institutions across Europe and Asia. Even more unsettling, the largest American banks have quietly stepped out of the blast radius and positioned themselves to profit from the fallout. For the first time in roughly 4 decades, they've switched sides in the silver market. The price you see on your screen right now, hovering somewhere in the low 70s, is almost irrelevant. That number is a placeholder, a digital mirage. It represents a promise made by a paper system that is already functionally insolvent. This week, the world is going to be reminded painfully that there's a difference between the price of a contract and the price of metal. To understand how we got here, you need to understand something that almost no one outside the industry ever thinks about. Every December, something strange but entirely predictable happens in global financial centers. The senior traders, the veterans with decades of scar tissue and crisis muscle memory vanish. They go skiing, sailing, disappearing into resorts with bad Wi-Fi and good wine lists. What's left behind is the B team. Younger traders, junior risk managers, people whose primary mandate during what insiders call Ghost Week is simple. Don't break anything. Ghost Week is supposed to be quiet. Volume dries up, markets drift. Nothing interesting happens because nobody wants interesting when the adults aren't home. But this year, something went wrong. The B team didn't just nudge a setting or misprice a spread. They compromised a core containment system that has kept the silver market under control for 40 years. And now the senior people are back, staring at the damage, realizing that none of their crisis manuals account for this particular failure mode. Across New York, London, Toronto, and Tokyo, risk managers are reviewing positions that make their stomachs drop. Hedge funds are calling emergency investor calls. Executives are realizing that trades placed during a sleepy holiday stretch may be large enough to threaten balance sheets, not bonuses, actual solvency. And while screens still flash a tidy number for silver, everyone in the room understands it's meaningless. For decades, the architecture of the silver market relied on a beautifully simple trick. Whenever silver prices threatened to rise, major bullion banks sold silver they didn't actually have. Paper, silver, futures contracts backed by nothing more than confidence and continuity. This manufactured supply capped prices again and again. 40 years of rallies quietly strangled before they could run. The evidence was never hidden. The CFTC published the concentration data. Whistleblowers testified. Lawsuits were filed. Hearings were held. And nothing changed because the institutions involved were too large, too connected, and too systemically important to challenge. Then something shifted in 2025. Veteran traders have started calling it the Great Betrayal. And once you see it, the current chaos makes a lot more sense. The December 2025 CFTC bank participation report landed like a glitch in the matrix. For the first time in modern history, the 4 largest American banks were no longer net short silver. They were net long. Read that again. The same institutions that spent 4 decades suppressing silver prices had flipped their exposure entirely. The architects of suppression had repositioned themselves to benefit from rising prices. In futures markets, every long requires a short. The math always balances. If the American banks moved long in size, someone else had to absorb the short exposure they abandoned. That exposure didn't vanish, it was transferred. Quietly, systematically, and with incentives attractive enough to dull suspicion, European banks, Canadian institutions, Asian financial entities, over roughly 18 months, these players took on short positions they believed were manageable, well-structured, and business as usual. They thought they understood the risk. What they didn't understand was timing. They didn't realize they were stepping into a trap just as the physical silver market was tightening beyond anything seen in decades. That trap now holds more than 215 million ounces of short exposure. To put that into perspective, that's roughly a quarter of global annual silver production. And it's concentrated in the hands of institutions that cannot source physical metal at scale. There is no inventory to tap, no hidden stockpile to borrow. The cupboards are bare. Here's the part that changes everything. The American banks are no longer motivated to keep silver cheap. Their profit now depends on higher prices, not lower ones. They don't want stability, they want movement, fast movement. Every dollar higher silver goes tightens the vice on the foreign banks holding the short end of the trade. This is why the current price feels surreal. It's not a clearing price, it's a delay mechanism, a number maintained by a paper system that assumes cooperation from players who no longer share the same incentives. Once that cooperation breaks, price discovery doesn't happen gently. It snaps. If this feels uncomfortable, it should. Markets don't like it when decades-long assumptions suddenly stop working. And silver, the most quietly manipulated metal on the board, is now the place where those assumptions are being stress tested in public. Nobody knows exactly how fast this resolves or how high prices ultimately go. What is clear is that the old playbook is gone. The containment failed during Ghost Week. The exposure was already too large to unwind cleanly, and the institutions that used to keep the lid on are now standing on the other side of the trade. That's why this Monday morning matters. Not because of panic, but because of recognition. The system didn't break overnight. It cracked while everyone was on vacation. And now the people paid to manage risk are realizing that the risk has already escaped the spreadsheet. If you're wondering why the tone in certain trading rooms has shifted from confidence to quiet panic, here is the simplest explanation. Higher prices are no longer a threat to the biggest American banks. They're the objective. 150, 200, pick a number. Every dollar silver climbs is another dollar flowing into their long positions and another dollar dragging their foreign counterparts closer to insolvency. For decades, the game was about extracting value from the public. Now it's far more surgical. The same institutions that once worked together to control the market have turned inward, and they're stripping each other for parts. If there were a term for financial friendly fire, this would be it. What's about to unfold isn't a random blow-up. It's a controlled detonation. Billions in losses are being funneled away from European and Asian banks and quietly absorbed by American institutions that position themselves early and decisively. It may go down as one of the most deliberate ambushes ever executed in a commodity market. But here's the key point. The infamous 15 million ounce short position, the so-called death bag, isn't enough on its own to create this level of chaos. For the trap to fully close, the physical silver market itself had to break. Completely. And it has. As of this morning, silver no longer has a single global price, it has three. And they don't talk to each other. The first price is the one most people see, the New York paper price, the number scrolling across financial television and glowing politely on Bloomberg terminals. Roughly $73 an ounce. Clean, simple, comforting, and almost entirely fictional. That price represents leveraged paper contracts traded on COMEX. It is the price of a promise, not the price of metal. You cannot take that number to a warehouse and walk out with silver unless you're willing to wait, negotiate, and accept substitutions that start to look suspiciously like excuses. The second price lives in Shanghai. While the West was distracted by fireworks and champagne, the Shanghai Futures Exchange did something that made veteran metals traders rub their eyes and refresh their screens. Silver closed near $89 an ounce in dollar terms, a $16 premium to New York. In a functioning global market, that spread shouldn't exist for more than a few minutes. It should be instantly arbitraged away. But it wasn't. It held. And then it widened. The third price is the one that really matters, because it exists where paper explanations stop working. Walk into a bullion dealer in Tokyo, Ginza district, and ask for a standard 1 ounce silver coin. Not a collectible, not a limited edition, just ordinary bullion. The price you'll see is closer to $130 an ounce. That's not a gimmick. It's not a luxury markup. That's the clearing price for actual metal available right now to anyone who can pay. In a healthy market, a nearly $60 gap between New York and Tokyo would be a gift. Traders would buy in New York, ship the metal east, sell it in Tokyo, and flatten the spread. That's how global price discovery works, or at least how it's supposed to work. The problem is that the arbitrage mechanism is dead. Secure logistics firms like Brinks and Loomis are fully booked into February. Every armored truck, every insured cargo plane, every secure transport lane is already spoken for. The companies that actually need silver for industrial use saw this coming months ago and quietly locked up the entire logistics chain. Even if you could find transport, the insurance market has slammed the door. War risk premiums through the Red Sea are now eye-watering. Tensions in the South China Sea have turned Pacific routes into a bureaucratic nightmare. On paper, arbitrage looks easy. In reality, it's impossible. The result is a bizarre split-screen world. The West is drowning in paper claims. The East is hoarding physical metal. And there is no bridge between them. The foreign banks holding those massive short positions can see the spread. They can do the math. They know silver is selling for dramatically more elsewhere. But they can't get their hands on it. They can't ship it. They can't use it to cover. They're watching the waterline rise, knowing exactly where the lifeboats are, and realizing they don't have access to any of them. Even that, however, wouldn't be enough to fully implode the system on its own. For this to reach critical mass, the underlying supply of silver had to be removed from circulation in a way that made covering shorts not just painful, but mathematically impossible. And that's exactly what's happening. Two forces are now vacuuming physical silver out of the global market, and neither one cares about COMEX pricing, paper settlement, or market tradition. The first force is industrial, and it has a brand name everyone recognizes. 3 weeks ago, Samsung confirmed that it has achieved mass production capability for solid-state batteries. Not lab samples, not pilot projects. Full-scale manufacturing, ramping right now in South Korea. This is a genuine leap forward in battery technology. A longer range, faster charging, safer chemistry, longer life. Every automaker on the planet wants this technology yesterday. And what most people don't understand is the silver intensity. Traditional lithium-ion batteries use about an ounce of silver per vehicle. Solid-state batteries use roughly 1 kilogram. That's not a typo. That's a 30-fold increase. Now run the numbers. The world produces around 80 million vehicles a year. If just 20% of that production transitions to solid-state technology, that single application absorbs roughly a quarter of global annual silver mine supply. Samsung isn't waiting in line at futures exchanges. They're bypassing the market entirely. Reports out of Mexico describe procurement executives landing private jets directly at mine sites. No middlemen, no hedging, just contracts, cashier's checks, and offers north of $80 an ounce for silver that hasn't even been extracted yet. They're locking up supply at the source. By the time that silver would normally trickle into global inventories, it's already spoken for. The second force makes normal economics irrelevant. The Pentagon. Modern military hardware is soaked in silver. Guidance systems, electrical components, satellites, drones, advanced aircraft. A single Tomahawk missile uses around 15 kilograms of silver. Fighter jets contain hundreds of ounces. When defense procurement decides it needs metal, price is not a constraint. And they don't negotiate with futures markets. They don't care about margin calls. If silver is required, they buy it. At $50, at $100, at $500. National security doesn't wait for price discovery. An inelastic buyer with effectively unlimited resources entering an already tight physical market doesn't just move prices. It breaks models. The Pentagon does not care who is short. It does not care who miscalculated risk. The metal will be acquired, and everyone else will deal with the consequences. Even with Samsung and the US military pulling supply out of circulation, the system might have limped along a bit longer. But the final blow landed quietly on January 1st. While much of the West was nursing hangovers, China enacted what it calls a strategic resource control mandate. The implications are enormous. China refines roughly 40% of the world's silver. Ore from mines across the globe flows into Chinese refineries before being distributed back out to industry. It is the choke point. As of January 1st, the number of export waivers for refined silver leaving China is 0. Not reduced, not limited. 0. Roughly 15% of global silver supply is now trapped behind what can only be described as a resource wall. That metal isn't coming west. It's being reserved for domestic priorities. Solar panels, batteries, industrial manufacturing. The global market didn't just tighten, it fractured. And once a market like this fractures, it doesn't heal quietly. It resolves violently. This is no longer about speculation or sentiment. It's about physics. Metal that cannot move, demand that will not wait, and paper promises that are being called all at once. For most of the last 40 years, the Western precious metals market survived on a kind of financial merry-go-round. Silver was leased, released, borrowed, pledged, and promised in looping circles that allowed the same physical ounces to support dozens, sometimes hundreds of separate claims. Banks lent silver to each other. Refineries borrowed against future output. Traders treated tomorrow's production as if it already existed today. It all worked because fresh metal kept entering the system, quietly refilling the shelves just fast enough to maintain the illusion. That illusion ended the moment China shut off the tap. When the flow of new refined silver stopped, the carousel didn't slow down gracefully. It seized, and everyone who depended on that incoming supply to meet obligations suddenly discovered that the vaults they assumed were full were, in fact, echoing. What's happening right now at COMEX is the most visible proof, and it's honestly baffling that this isn't dominating every financial headline. The registered inventory at COMEX, the silver that is actually designated for delivery against futures contracts, has fallen to roughly 39 million ounces. 2 years ago, that number was comfortably above 100 million. It didn't collapse overnight, it drained steadily, then rapidly, and over the holidays, the outflows turned aggressive. In the first 2 trading days of 2026 alone, over 17 million ounces were delivered. That moves roughly 2% of the world's annual silver mine production, vanishing in 48 hours. This isn't normal settlement activity. This is what a bank run looks like when it happens inside a commodities exchange instead of a retail branch lobby. At the current rate, COMEX has maybe 2.5 days of registered inventory left. If delivery requests continue anywhere near this pace, by midweek there will be nothing left to deliver. And when that moment arrives, the exchange will not stand up and admit the cupboard is bare. Instead, they will do what exchanges always do in these situations: invoke force majeure provisions and settle contracts in cash at the official exchange price. You'll be paid $70-odd an ounce in a currency that is quietly losing purchasing power, while the real-world price of physical silver races far beyond that level. It's not theft in the dramatic sense. It's confiscation by fine print. The Federal Reserve saw this building. On December 26th, while most people were dealing with leftover turkey and return receipts, the Fed quietly injected over $17 billion into the banking system through emergency repo operations. The goal was simple: prevent stress in the silver market from spilling over into broader financial contagion. The problem is that liquidity doesn't solve elemental shortages. You can print dollars indefinitely. You can expand balance sheets, backstop counterparties, and stabilize funding markets. What you cannot do is print silver atoms. The periodic table is famously unimpressed by monetary policy. Silver is an element. It has to be mined, refined, and physically delivered. There is not enough of it available to satisfy the claims that have been written against it. The Fed's intervention was a tourniquet applied to a severed artery. It may buy time. It may delay panic. It does nothing to fix a market that has sold hundreds of paper claims for every ounce that actually exists. Now let's talk about you, because macro narratives are entertaining, but useless if you don't understand where you personally stand. If your exposure to silver exists through ETFs, futures contracts, or unallocated accounts at bullion banks, you are inside the blast radius. When delivery becomes impossible, those structures are designed to protect the issuer, not you. They will settle in cash. They will point to the contract language. You will receive paper profits at paper prices, while the purchasing power you thought you owned evaporates in front of you. Meanwhile, the physical retail market has already frozen. Over the past week, I contacted 14 major silver dealers across the United States. Every single one has pushed shipping estimates out to March 2026 or later. Not because they're playing games, not because they're hoarding, because there is simply no inventory to ship. Industrial buyers intercepted supply before it ever reached retail channels. One dealer, a man who's been in this business for 37 years, told me he's never seen anything like this. He said it reminds him of the Hunt Brothers era, except worse. Back then, the metal existed somewhere. Today, he said, it's genuinely gone, consumed by industry, locked behind China's export controls, pre-purchased by Samsung and defense contractors before it ever hit the open market. This is not a squeeze driven by speculation, it's a shortage driven by physics. If you already hold physical silver, it's important to understand what you're holding right now. This isn't a trade, it isn't a bet. It is a claim on one of the most strategically important industrial commodities on Earth at a moment when supply is constrained and demand is non-negotiable. Mines cannot ramp production fast enough to matter. Refining capacity is bottlenecked. Recycling flows are overwhelmed. There is no emergency reserve waiting in the wings. No white knight arriving to save the short sellers. The so-called death bag is detonating in real time. Foreign banks are facing margin calls they cannot meet. Risk committees are holding emergency sessions that stretch late into the night. Lawyers and regulators are being looped in. Somewhere, right now, executives are realizing that positions entered casually during holiday, ghost weeks may be existential. And the American banks that orchestrated the exit, that flipped their exposure months ago, are watching from a safe distance, running the numbers, preparing to collect. Here's a simple analogy that captures the essence of what's happening. Imagine a vault containing a single silver bar. Over the years, the manager hands out 356 claim tickets for that one bar. People trade those tickets among themselves, confident that redemption will never be demanded all at once. The tickets circulate. Prices are managed. Everything appears stable. Then one morning, several very serious buyers walk in and ask for the metal. Not tomorrow, not in cash, today. Suddenly, the manager realizes there is one chair and 355 people who all believe they entitled to sit down. Samsung walks in and needs silver for batteries. The Pentagon walks in and needs silver for weapon systems. The largest American banks walk in and quietly make it clear they will not accept cash substitutes. The exits close. And everyone holding paper discovers that paper does not bend the laws of supply. The next phase will unfold faster than most people expect. And once manufacturers collectively realize that affordable silver is not coming back, procurement behavior will change overnight. Companies don't wait politely when their production lines are at risk. They hoard. They outbid. They secure supply at any price because the cost of running out is higher than the cost of paying up. When that industrial panic collides with forced short covering from institutions trapped in impossible positions, price action won't resemble a trend. It will resemble a jump cut. $5 gaps, $10 gaps, $20 gaps in single sessions. Circuit breakers will trigger. Trading will halt. When markets reopen, prices will be higher still. $100 won't be a milestone. It will be a baseline. 150 won't be aspirational. It will be transitional. The move 1T stop until paper and physical markets are forced back into alignment at levels that sound absurd until they reprinted on a screen. The era of cheap silver didn't fade away. It ended abruptly on a Monday morning when the senior traders came back from vacation and realized the containment had failed. The next 72 hours will separate real ownership from contractual promises. Metal available last month is gone. Metal available last week is gone. Metal available today is disappearing as you listen to this. If you've made it this far, you now understand something most people don't. What you do with that understanding is up to you. Just don't assume the market will politely give you another chance. It rarely does. Hold what you own. Don't let volatility shake you out. This isn't noise. It's a structural reset. There is no rewind button on supply shortages. Stay calm, stay rational. And welcome to what real price discovery looks like.